David Burrows is President and Chief Investment Strategist at Barometer Capital Management. He's also our guest on this edition of Market Call. We're talking North American large caps at 1-855-326-6266. We've got the Twitter machine up and running, as Mark tweeted in, asking if you like Canadian banks. And if you do, who do you favor? I think I know the answer to this question in 140 characters.
Okay, so to come at this from the macro level, Canada is slowing relative to the U.S. U.S. is improving. U.S. banks, way cheaper than Canadian banks, but with faster earnings growth. They've been held back from paying dividends, so their dividend payout ratios are extremely low relative to history. Canadian payout ratios are up around the average. So I think we see much better dividend growth out of the U.S. They are the natural beneficiary of an improving consumer economy. Canada, natural slowdown due to a slowing commodity economy. So I'd rather own something like a Wells Fargo, for instance, that has very domestic exposure to the U.S. housing market, which is showing some signs of improvement. New house starts were up 20% in the month of May. And so I think that you're going to get better dividend growth, better earnings growth, better multiple expansion, which is really important when you're making an investment. And I think that it's a very conservatively run bank.
There's Wells Fargo at $56.02, trading with a price-to-book ratio of 1.7 versus Canada's biggest bank, Royal, trading 2.2.
Right.
Just by that simple metric, the American banks are cheaper.
Yeah, and if you're going to get better dividend growth out of the U.S. banks, I think you're much better off.
All right, the dividend on Wells Fargo stands, Mark, at this point at 2.7%. That's 37.5 cents. Thanks for the tweet. Natalie in Toronto, thanks for your patience. Welcome to Market Call.
Hi, thanks for taking my call. Mr. Burrows, I've been holding American Tower since the mark of around $80. I noticed that it's not going anywhere. I mean, it sort of fluctuates a little bit. I'd like to have your opinion if I should continue to hold, and if not, who would turn to? Right. So thank you for taking my call.
Natalie, this is a great example of a great house in a difficult neighborhood. The REIT sector is a sector that has a real impact when interest rates start rising. We'd call them like an interest rate proxy or a bond proxy. So they are not terribly economically sensitive. If you think the economy is getting a little bit better, you may want some more economic sensitivity. American Tower is growing its dividend very nicely, growing its cash flow very nicely, but it's in the REIT sector and does get impacted by the negative view of REITs currently. As investors, we have to be tactical and pick our spots for what the current environment is telling us. And I would encourage you to look at something in the technology sector, like some of the big cap technology stocks that are growing their dividends very nicely. You know, you could look at a company like, Microsoft for one. I mean, you could look at a Xilinx Semiconductor. These are bigger yielding names. You could look at a consumer stock like Home Depot that's growing its dividend at 25% a year, but benefits their same sort of sales growth in the most recent quarter, 7% growth versus the economy growing at 2%. So those are the sectors I'd be pushing you towards. Healthcare is another. These are the groups that are more beneficial. And frankly, financials right now, I think, is the number one group to focus on. It's the one group that benefits from rising rates. And we'll talk about a couple of picks today.
All right. And Natalie, the 5-year growth in dividends at both Microsoft and Home Depot, 18%. Thanks for the call from Toronto. Bill in Canmore. Hello.
Hello. I'd like your opinion on Mondelez. And is there a currency risk with the U.S. dollar going up? Thanks.
All right.
Okay. So on Mondelez, Mondelez is the international snack food business that came out of Kraft. It is a higher growth business than the main staples business that they had. I think that this gives you good exposure to a globally growing consumer. If you look at some of the emerging markets, the difficulty in some emerging markets is for the companies that are more resource focused, like in Latin America and so on. The consumer in emerging markets is growing rapidly. So Mondelez is a great play on a global consumer. If you look at it relative to, say, the consumer staples group, it is an absolute outperformer. And a lot of the costs in a business like Mondelez are more local by nature because they have local distribution, local salespeople, local production. So currency doesn't tend to be a huge impact. Maybe as we report it back to U.S. dollars, but really it's a shorter term issue in nature. So I have no problem. We don't own the stock, but I would have no problem buying it.
I'm looking here at street consensus of $42 on it over the course of the next 12 months, and that would suggest a 4% upside from here. But you also have that 1.5% dividend rolled in. Is there a cheaper entry point, do you think, than $40.50?
Look, it's trading within a whisper of its highs.
Higher highs and higher lows.
Yeah, I have no problem paying highs. I mean, for a stock to go from $40 to 100, it's got to go through 42, 46, 50, 54, and so on. This business is well positioned. It's executing. It's generating lots of cash. I think that this is a lower risk way of investing in the global consumer.
The technical guys will look at an upside trend, as we looked at that 10-year view on Mondelez, and put trend lines below and above. And then as you see the oscillations from highs to lows within that trend range, you would buy on the lower end of that trend range. Do you use that as a method of getting in on something that clearly has an upward trajectory?
Really, we are looking, the name of our process is disciplined leadership approach. We look for leading companies, and I'm very happy to buy things trading at the highs. We don't tend to buy pullbacks. This is behaving exactly as it should be if you believe things are getting better. It's been a very orderly advance, and I don't think it's a terribly expensive stock.
All right, Bill, thanks for the call from Canmore. Say hello to Mike for us. We're taking a short break. David Burrows is here, President and Chief Investment Strategist at Barometer. We'll look at his past picks. They're up more than 25% in the last year. And then back to your questions on North American large caps at 1-855-326-6266.